Welcome to our annual halftime report. We're very happy to have all of you watching and look forward to sharing some important market information with you. I'd like to draw your attention to these disclosures so I can keep the regulators and attorneys happy. Our goal today is to walk through some of the market fundamentals from the first half of 2017. Of course, it would be impossible to cover everything that's happened so far this year. We believe we can get a relatively clear picture by sticking to the market fundamentals despite what the political and business talking heads tell us. Let's look at where we've been, where we are, and where we're headed to help guide the investing process. With that said, here's what we'll cover today. Let's start by looking at the first half of the year. In the first 6 months, the U.S. economy continued its modest but steady growth. This economic expansion has lasted 95 months, the third longest in the 33 business cycles since 1854. Some analysts believe our current expansion has a chance to become the longest expansion in history. Here's a snapshot of the S&P 500 performance for the first 6 months of 2017. The Standard & Poor's 500 index is designed to measure performance of the broad domestic economy through changes in the market value of 500 stocks representing all major industries. The S&P ended 2016 at 2239 and closed June 30th at 2423. Over the first 6 months of the year, markets marched to new highs on strong corporate earnings and tuned out noise from Washington. In June, volatility returned due to a tech stock slump, uneven economic numbers, and falling oil prices. You can see the general trend of this graph head up at a modest angle with relatively few dips. Over the course of the first 6 months, the S&P 500 performed very well against expectations, rising by 8.2%. In addition to the strong S&P 500 performance, the Dow roared past 20,000 for the first time ever and registered 22 record highs in the first half of 2017, rising by 8%. And thanks to the tech sector, the Nasdaq rose 14% since January. Each year, many of Wall Street's top economists and analysts give predictions for the year ahead. In January, experts predicted a year of positive returns. The forecast average for the listed analysts was 5.8% growth prediction. However, the actual S&P 500 finished the first half of the year with an 8.2% increase. Now, let's look at some specific sectors to better understand how we got here. To put today's economy in perspective, let's begin by looking back to December 2008. The worst financial recession in 80 years. Here you see 20 speedometers representing 20 leading financial indicators. 15 of the 20 are red, which correlates to negative or weakening numbers. There's a lot of red on the screen. By comparison, in January 2017, 16 out of the 20 indicators reported positive numbers. Those appear in green. The market performed significantly better at the start of the year than during the recession. There's no red on the screen here. And here's where we are today. 17 out of the 20 indicators report positive numbers. Since January, even the global economic outlook has moved from yellow to green. Let's get a better sense of some key domestic indicators and their role in the year's slow, steady rise. Corporate earnings may have been the single most important market driver in the first half of 2017. Corporate earnings were spread across the sectors and energy led the way. First quarter earnings were especially strong as 75% of the S&P 500 companies beat their earnings estimates. Technology stocks account for 22% of the total S&P 500 stocks, the largest sector by far. For comparison, financials, the second largest indicator, accounts for only 14.5% of the S&P. For most of the year, tech stocks performed well and had risen 16% since January. In June, however, the tech sector slumped amidst the stock sell-off. Analysts are still debating the causes and are encouraging investors not to overreact. Now, these graphs show both the year-to-date U.S. inflation rate and the recent Fed's interest rate increases. As you can see, the inflation rate has dropped each month since February and is now below the Fed's inflation target of 2%. Still, the Fed has modestly increased interest rates to tighten money. The Fed has suggested it will stay the course when raising interest rates, believing inflation will hit its targeted 2% because of continuing low unemployment. Rising interest rates generally tend to slow economic activity down, thus lowering inflationary pressure as borrowing becomes more expensive and consumers tend to save more. The unemployment rate in the U.S. is continuing to fall, reaching toward the lowest numbers in 16 years. Jobless benefit claims are also falling, pointing to a healthy labor picture. Now, Consumer Sentiment polls 500 households a month on their financial circumstances and economic outlook. The poll is important as it helps analysts understand consumer spending, which accounts for more than 2/3 of the economy. Following the presidential election, consumer sentiment bumped significantly. In June, however, the numbers suggested consumer optimism may be wearing off. Now, strong consumer sentiment doesn't always translate to strong consumer spending. From January through May this year, retail sales underperformed despite high consumer confidence and a solid labor market. Unemployment posted lower numbers, but low wage increase rates translated into weaker consumer spending. Oil prices experienced a rough first half of the year, thanks in part to global oversupply. Yet some analysts are expecting prices to bounce back by year's end. Earlier in the year, OPEC announced its goal to reduce stockpiles by June. In response, U.S. oil drillers ramped up production. When OPEC did not hit their 5-year average last month, analysts saw it as a chance for the price per barrel of U.S. crude oil to increase. In June, the price per barrel fell to $42, roughly 14%. As we start the second half of the year, oil prices are slipping again and seem stuck under $50 a barrel, with excess supplies and overproduction still the culprit. Now let's turn to some global markets. Significant political developments occurred globally between January and June. Despite political challenges, markets could see more advances. However, continuing issues could also create some problems for market gains later. Now, whether Trump and the Republican-controlled Congress deliver on health care reform, tax reform, and infrastructure investment will influence markets in the future. However, the markets were not hurt despite some negative pundit predictions. The markets brightened as Emmanuel Macron defeated the far right. The new French president is a centrist who supports the EU and may be able to lead French economic reforms. Britain and the EU need to engage in realistic discussions about the UK's exit from the European Union, and that should settle markets on this point. Continued missile testing by the North Korean regime is creating more geopolitical concern. On July 4th, North Korea fired the first intercontinental missile, raising the stakes for all concerned. Saudi Arabia, the United Arab Emirates, Egypt, and Bahrain are accusing Qatar of supporting terrorism. How this all plays out could also influence the market. Now, the MSCI EAF measures large and mid-cap stock performance in 21 developed countries outside of the US and Canada. For the first half of the year, the EAFE rose 11.5% from 1689 to 1883. The emerging markets are benefiting from solid revival in global growth. The MSCI EM index performance rose an impressive 17.2% during the first half of the year. The index is derived from large and mid-cap stocks in 23 countries with developing economies. MSCI also added Chinese stocks to its emerging market index in May. This slide shows the Euro Stoxx 50 stock market index for the first half of the year. This index is a good proxy for general European equities market. The European economic situation continues to improve in 2017. Growth is spreading across the region. Consumer consumption is improving. Businesses are reporting rising new orders. Strong labor markets are showing the fastest job growth since 2015, and the European Central Bank is studying how to unwind its stimulus programs. Also of note, in June, Greece's creditors agreed to additional loans, easing tensions over this long-running issue by avoiding a Greek loan default. Now let's turn to the second half of the year. Remember this slide? These analysts revised their numbers and now predict a 9.8% increase over the end of 2016. Since January, 7 out of the 12 experts revised their numbers upward and 5 stayed the same. This mild confidence in market growth reflects the movement we've been seeing, slow and steady. In 2016, the U.S. economy expanded by 1.6%. Since January through June 30th, the GDP has risen by 1.4%, and analysts are predicting it will hover around 2% growth to finish out the year. President Trump's plan to increase the GDP by 3% seems a stretch right now, as no major economic policies have been developed or applied yet. The dollar fell at the end of June, posting its biggest quarterly decline in almost 7 years against rival currencies. What does this really mean for the U.S. economy? Well, a weaker dollar is good for companies involved in export. U.S. goods are cheaper to make and can be sold outside the U.S. at a greater margin when the dollar is weak. In addition, companies with income outside the U.S. will report stronger earnings, as the stronger foreign currencies convert into more U.S. dollars when the dollar is weak. Corporate earnings growth should continue in the second half of the year, with most companies continuing to earn respectable profits. The S&P 500 is currently trading near its highest prices in more than 10 years, roughly 18 times the expected earnings over the next year. The Federal Reserve has repeatedly announced plans to raise interest rates once more in 2017 and possibly 3 more times in 2018. They've already increased rates 3 times since the financial crisis. Despite low inflation, the Fed is banking on a strong labor market driving wages. Analysts and experts will stay focused on this fundamental and watch how increased interest rates and inflation rates play off each other. The Fed also plans to trim its $4.5 trillion balance sheet, which is referred to as quantitative tightening, reverse the quantitative easing from the 2009 recession. The Fed has never been in this situation before. As such, investors and analysts alike will closely watch how the tightening affects U.S. and global markets. Over the next 6 months, we'll be thinking about a few fundamental questions. Will low unemployment translate in the second half of the year into wage increases that will support increased consumer spending? Will builders be able to transition profitably to housing at prices more in line with the needs of first-time home buyers? Can oil producers really stem production and get prices up? Will consumer spending strengthen in the second half of 2017? And where are the investing opportunities if the U.S. dollar continues to weaken or if it rebounds? Will inflation rise toward the 2% goal of the Fed? And can the Fed start selling off its $4.5 trillion balance sheet and assets in a way that does not roil the markets? Tuning out political noise while managing your finances is not always easy. If you leave with one thing today, we hope you remember to focus on the fundamentals. As the market continues its slow and steady climb, don't let your emotions dictate your investing. The economy continues to grow at a steady but modest rate in 2017, and we see this trend continuing. Investing wisely involves more than reacting to soft factors like consumer sentiment or to geopolitical tremors. For investing opportunities, we urge you to stay focused on company earnings and opportunities as well as global economic fundamentals. If you have questions about your investment or income plan, please contact us and we will be happy to review them and make sure you are on track to meet your goals. Thanks for choosing Pineywoods Financial.
While we believe the information in this report is reliable, we cannot guarantee its accuracy. Opinions expressed are subject to change without notice and are not intended as investment advice or a solicitation for the purchase or sale of any security. Please consult your financial professional before making any investment decision. Investing involves risk, including the potential loss of principal. No investment strategy can guarantee a profit or protect against loss in periods of declining markets. The indices mentioned are unmanaged and cannot be invested into directly. Past performance does not guarantee future results.